Welcome to another episode of Investing with IBD. It's Justin Nielsen, your host here, and I've got a question for you to think about, a little philosophical question. When you kind of think about your portfolio, is it one of those things that you just kind of hold faith into the stocks that you own? Or are you looking at some cold hard facts, some objective reality? And how do you know the difference? That's one of the questions we're going to get into here today. It's February 7th, 2024. And as always, I've got Arusha Piras from O'Neill Global Advisors joining me. He is a portfolio manager over there. How you doing, Arusha?
I'm doing well, Justin, and once again, a very interesting intro.
Well, and did you take philosophy classes when you were in college or high school?
No, I wanted to make the most of my money, so
Okay. Uh-oh. Well, be careful because we are going to have
yeah, exactly.
a doctorate.
I didn't read the crowd today, so
Right? Yeah.
yeah.
We're going to have a doctorate of philosophy on today. And of course, that's Dr. Thomas Carr. He is the founder and CEO of Befriend the Trend LLC and also Dr. Stoxx Trading. Great to have you back on the show, Dr. Tom. How you doing?
I'm doing fine. Thank you, Justin. Great to be back. Good to see you too, Arusha. Thank you.
Yeah. I apologize, Doctor.
Yeah. So we're going to get into some of the things in terms of philosophical considerations for stocks and how to use that for your investing. And I think again, no better person to have on than a doctorate of philosophy, of course. Or was it philosophy or actually theology? Now that I remember.
Well, I got my doctorate from Oxford in a combined program. So I took 2 years of philosophy, 2 years of theology, and then wrote a dissertation on the basis of that interaction. So a little bit of both, actually.
A little bit of both. Okay, covering all of our bases. And of course, that's also where the little nod to faith comes in. But before we get into that, let's get into the markets a little bit. And of course, we'll also get into some of the stocks that are on Dr. Tom's radar. But gosh, this market, I mean, when you look at the NASDAQ composite, every time we think, okay, you know what, it's extended and it's got to take a break. It lasts for like a day, and then we're right back up there to all-time highs in what looks like extended areas. So all-time highs for the S&P 500. I think we're really kind of bumping up against that level for the NASDAQ composite as well. What's your take on how we should be looking at the markets right now?
Well, you kind of hit the nail on the head that it is a what I like to call a market of cognitive dissonance. That's a bit of a mouthful, but it simply means that there are a number of things going on in the market that seem to be contradictory. You mentioned the S&P 500, the NASDAQ 100 at all-time highs. But if you look at the actual number of stocks that are hitting all-time highs, it's actually quite a small number. In fact, in the NASDAQ, at least, you've got far more stocks hitting new lows than hitting new highs. Mm-hmm. Now, some people will say that's not a sustainable thing, and we're due a very big market correction. And of course, a typical market, even a bull market, is going to have your 3 to 5% corrections, 4 or 5 of those every year. 7 to 10% corrections, 1 or 2 of those every year. And we haven't had a good correction since September, October. Mm-hmm. So it's been a little while. Anything more than 1%, 1.5%, we haven't even had a little dip, So we are due a pullback, but not necessarily because the market is a bit imbalanced. I mean, things come back into balance quite easily, quite quickly, as we see money flowing out of the big Mag 7 stocks at the top and flowing back into all those beaten down names that are trading around 52-week lows. And then, of course, the market can continue going higher because you still have a lot of good opportunity there. So I don't think we can look at that kind of imbalance. But again, it is a market of incongruity in a variety of ways. I mean, you've got gold trading like the Fed is never going to raise rates again, and you've got oil trading like the Fed is ready to hike, and you've got consumer confidence is at really high levels, and yet discretionary stocks have been having kind of a rough go of it. They're not nearly as performing nearly as well as the other sectors. You've got tech stocks, blue chip tech stocks, especially trading like it's 1999, and you've got small caps trading like it's 2002. So you just there's not that kind of balance in the market that we usually see with a bull market. You know, the rising tide lifting all the boats, as Warren Buffett likes to say. Well, it's not.
Yeah.
And again, that doesn't necessarily mean that we're setting up for a major fall or a major pullback or a major correction, but it does mean that we will likely see some sector rotation coming down the pike very soon. And I think we're already starting to see some hints of it. You know, we had NVIDIA, we had some of the semiconductors that have been so hot starting to come down a little bit. You know, today they got back on track, but they did come down a bit yesterday. SMCI, which has just been a skyrocketing stock, came in a little bit yesterday. I had a bunch of friends who were making big gains on buying puts yesterday with Friday's expiration. And hopefully they sold them all yesterday and didn't hold on to them today, because it was right back up. You've got Mike Wilson, who is kind of a perma bear out there shifting gears and saying the market's going to go up. And then you've got Tom Lee, who's a perma bull, out there recently saying, I'm kind of worried about a correction. So again, it's a market of cognitive dissonance or contrary viewpoints side by side. Both Citigroup and JP Morgan were out a couple of weeks ago with pretty bearish predictions, saying that a big correction was imminent. But the reasoning is because too many people are getting into the market. So, you know, they're saying the market is like too bullish, but here we have this bearish posture. So
that's the argument. So to that end, you know, in terms of things being a little extended, you have a chart here from Bloomberg that shows how the S&P 500 is, you know, well, I mean, if you look at the asset managers' futures positions, it's the highest in U.S. equities in 2 years. So kind of explain what this means to you.
Well, this was used as evidence that the market is due an imminent correction any day now. And it was published by Bloomberg, but there were several analysts that were latching onto it and promoting it and showing that asset managers are very, very bullish. They were very, very bullish also right at the end of 2020, when the COVID rally was, of course, in full swing, and the post-COVID rally, I should say. And they started to get very bearish right at the end of 2020 and continued to be bearish for several months while the market continued on higher. You know, not in a straight line. Of course, it never does go straight up, but the market, you know, they missed out on a good 1/3 of that whole rally. And for the most part, asset managers follow the price. So when price is going down, they tend to get out of the market. When price is going up, they tend to get back in. You know, if you buy the SPDR ETF, you're going to outperform 80% of all asset managers just by holding that one position. So they're not really the best in terms of money, but it does illustrate, I think, a bit of this disconnect that we have. You know, you've got the market continuing to go higher, and you've got quite a few people out there who are worried and fearful of a market correction. And of course, stocks like to climb a wall of worry. So as long as there are bears out there, we can be pretty sure that the market is not going to be crashing anytime soon.
So Dr. Carr, so you highlighted so many different, almost contradictory type of indicators, right? Where, how do you balance that, right? Obviously, you've been highlighting that there is an imbalance and not everything's lining up because you don't have this broad-based participation, and a lot of the sentiment indicators aren't aligned. So taking all these kind of contradictory things, how do you balance it and come to a decision?
Well, that's a great lead-in question to a little plug for MarketSmith, because MarketSmith helps all of us Number one, it gives us a good read on the overall market. You go to the MarketSmith webpage, the homepage, and you'll find out, are we in an uptrend, a downtrend, a sideways consolidation? You'll learn how many distribution days for the S&P 500, how many for the NASDAQ 100. You can kind of keep a running track of those over time to give a pretty good sense of whether the market is topping out or bottoming out or doing something in between. But then when I run my MarketSmith scans, and I've got them set to only give me the strongest stocks in the market, the leaders of the market. And whether the market is up or down, you're always going to have a handful of leaders that are doing pretty well. So that's one way, right? You keep track of the overall market by checking in each day with MarketSmith or the leaderboard or ibdinvestors.com to get a sense of what the overall market is doing. And then secondly, you keep an eye on the stocks that are doing well. And those are the guys that when the market is in a fully bullish mode, they're going to do very well. And when the market is not so bullish, they're going to still outperform. Mm-hmm. But yeah, we do a little bit of both in terms of buying the leaders and holding on to them as long as we can, and looking for those opportunities from the stocks where the sector rotation might be well coming into them. So those are the guys that are really going to go 30, 40, 50% in a month once they come back into favor. Now, finding those, that's a much more difficult trick. But again, there are ways of locating those stocks too.
Mm-hmm. Well, and maybe we go to the next chart because as you were saying, where the strength has been is really been focused on tech. So when we talk about the S&P 500, of course, the folks at State Street with their spider ETFs, the sector ETFs, and so on, they have shown that the XLK, which is the tech, is been really outperforming. And actually, we're going to need the other chart.
Sorry, I'm afraid I confused you all with my numbering system on the charts there.
Yeah.
I was like, wait, we'll go. Okay,
so yeah, you want the sector spider funds, which is
where is it?
And you'll see XLK at the right hand side. There we go.
Okay.
So this is a 5-year time frame that we're looking at here, and there's a lot of kind of messiness. There's 11 sector spider funds that kind of break down the S&P 500, and of course some of the top weighted stocks in the S&P 500, which is a market cap weighted index, are in the tech area. So you can really see how XLK, the tech spider ETF, is far and above everything else.
Right. And that's what I wanted to show with this slide, is that one of the concerns, one of the disconnects in this market is that you've got a handful of blue chip tech stocks, the Mag 7 and a handful of others. And it's actually quite a fairly healthy set of tech stocks that are leading this market higher. And they're outperforming by leaps and bounds above any other sector, 2 to 3 times as much over most of the other sectors. The other thing I wanted to show is that for the last 2+ years, those other sectors have been pretty flat.
Yeah.
They had a good run after the COVID crash, which you'll see down there at the beginning of 2020. But after that, it's been pretty much of a tight trading range for most sectors other than tech. Mm-hmm. So one of the things I would like to see, and I've been working on this thesis with I run a live trading room through our website. And one of the things I've been working on with some of my members in that group is the thesis that we are due not a market correction, but a correction in the sectors, a sector rotation.
The rotation, right.
Mm-hmm. The rotation, right. So, we should see some money coming out of the big blue chip techs and going into things like energy and communications and bonds and China. Now we've seen China actually up about 10-12% in the last week and a half. So that's one small promising sign that might lead to something a little bit bigger. We want China to come online because China is the marketplace for a lot of the smaller software plays and tech names and companies that really can't compete here in the United States, but they can do very well in China. And if China's economy is soft, then those guys aren't going to do very well. So we want to see China come back online, and that would give a real big boost, I think, to a lot of the smaller growth names that don't really have earnings yet, but they've got a lot of good potential. And so we're hoping for that. Energy is another sector we'd like to see come back online a bit better. And small caps. Small caps have been underperforming. And even here in the last couple of weeks, when we've seen such great gains in the Mag 7, the NASDAQ 100, small caps are still lingering in the middle of their trading range, not near the top. So again, we do need to see some rotation. What's going to be the catalyst for it? I don't know. When is it going to start? I don't know. What are going to be the sweet spots in the market? I'm not sure yet. So we're just kind of working on that thesis. But one of the things, of course, we'll keep an eye on are the inflows in terms of cash. We'll keep an eye on the option flow as well. If you start seeing a lot of longer term big bets being made on stocks that haven't been receiving much in the way of call volume, that's another trigger as well for us, at least.
Well, Arusha's now showing another chart that you brought up since you mentioned the small caps. Here's the NASDAQ 100 QQQ versus the Russell 2000, represented by the iShares IWM. And what should we be gathering from this? I mean, it certainly seems like when you compare the two, it's if you're going where the strength is, QQQ is where it's at, right?
That's right. Well, the one thing I wanted to point out about this chart, this is a weekly chart, and this is as much data as I could get into that time frame. If we moved out the time frame 10, 12, 15 years, you're going to see that we're up at all-time highs. So the small cap the tech sector, the blue chip tech sector, NASDAQ 100 relative to the Russell 2000 is at all-time highs in terms of outperformance. And one little glimmer of hope that we're going to see some rotation out of those top 100 tech names and into some of the small cap stocks is that we're starting to see some bearish divergence work into the indicators there on that double top that's forming in the price chart. So you can see it up at the RSI 14 at top. You've got a lower high relative to the price high, which is almost equal to where it was. And MACD is starting to roll over as well, a little bit more of a lower high there too. It's not much to go on, I admit. But the fact that we are at the peak or at the highest ever, at least in a decade or so that I can tell, of this ratio between NASDAQ 100 and small caps is worth paying attention to if we can start to see that roll over and gain some traction to the downside, which would be an upside for the small caps. If you compare, for example, one of the FANG funds, so you've got FNGU, which is a 3X bull conglomerate of 20 weighted big cap FANGs, and you've got BULZ, which is a 3X bull version of the top 15 unweighted or equal weighted tech stocks. Compare that to TNA, which is the 3X bull version for the small cap Russell 2000. And you're going to see something even more dramatic there, because there you're only looking at those top 15, 20 stocks.
Right.
So, okay. So I pulled
little
up.
hints. We've got China coming back online. We've got the potential for small caps rallying a bit here. And I'm not alone in calling for that. There've been some other guys I'm in a professional trading group that we bounce ideas back off of each other quite a bit. And, we've got a lot of eyes, 20 different eyes going in different directions, and that can really help. And it's their consensus generally, that small caps should do a pretty good run here into 2024.
So I pulled up I pulled up so FNGU, right? On so we have it currently up here. So this is the FANG index, 3 times the FANG index, which has gone on a pretty amazing run, up 47% from that last cup with handle. And then when you take a look at it and compare it to TNA, which is the small caps, 3 times the small cap, the Russell 2000, has gone nowhere, but maybe slowly setting up here, right? Maybe finding some support. Obviously, a breakout past the 42, 43 area would be a positive here.
Right. It does kind of, if you squint, you can kind of see an inverted head and shoulders there.
Yeah. Yeah.
That's the hopeful side of me coming in. What we really need to see there, though, if you look down at the volume bars down below, you're seeing a lot of red, not a whole lot of blue. And there's some very tall reds in there and only a handful of tall blues. So you want to see that ratio switch around a bit. More blues than reds, more taller blues than reds to get a better volume balance. But if that could happen next week, so we'll never know. But it does look like it is in the process, at least, of bottoming out.
Mm-hmm. Well, to kind of maybe take the other end, which, you kind of from the outset had a lot of, well, on the other hand, this, on the other hand, this, there's a lot of, as you said, that contradictory information. I mean, for, the favor of the tech stocks, especially the big cap tech stocks, you've got a lot of people, still talking about AI, artificial intelligence being in its infancy, and NVIDIA, Microsoft, some of the big guys being the big beneficiaries of that AI trend. And, for the small caps, a potential headwind. I mean, we just had NYCB, really take it on the chin, New York Community Bank Corp. And that's been bringing a lot of the regional banks down. And what is it, like 15 to 20% of the Russell 2000 is made up of regional banks, which, again, if we, if there's another shoe to drop like we saw last year in Silicon Valley Bank, that could be a headwind for the small cap index, the Russell 2000. So is there the potential here that, kind of like, to bring it back to what you were originally saying, the trend is your friend, befriend the trend, if the strength is working, and the small caps aren't, why would you be looking for it to change necessarily?
Well, and you're right. We're actually not in small caps. We're not in TNA or IWM, and
not yet.
We've been day trading. Not yet. We've been day trading the regional bank 3X ETF fund, but we haven't been in that for about a week now. We had a couple of really nice trades, and then we got out just before the bank, New York Community Bank, crashed. This morning, however, we put on some shares of New York Community Bank when they came out with news that they're not seeing much outflow. They're not seeing people running for the exits. And it bounced up about 20% within a matter of minutes. It was quite a fun little day trade. So there are plays like that. There's going to be opportunities like that, of course, every day in every sector. But we're not going after a weakness. Now, here's a good lesson that we all can learn from William O'Neill. And I want to talk a little bit about him today also. But and let me get you his exact quote here. He said, "The first thing I learned about how to get superior performance is not to buy stocks that are near their lows, but to buy stocks that are coming out of broad bases and beginning to make new highs." And he's absolutely right. Absolutely right. So what we do, what I teach, is that you use your trading account, you divide it into however, based on your risk tolerance, 70%, throw it into the big leadership stocks that are doing really well, have great growth, great price performance, great relative strength. And I'll show you in a little bit how to find those using MarketSmith. And then take 30%, 25%, and do your lotto trades, your fun money trades, the kinds of things that are much riskier.
Your NYCB trades.
Yeah, that's your NYCB trades. Much riskier, but with small size, you can sleep at night, not going to dent your portfolio if you take a big loss. And of course, you want to use stop losses in any case. But yeah, no, this is not a market. This is not a market for going after some of these beaten down software names. And there's some beautiful companies out there that had great runs last year and are down near 52-week lows this year so far. I'm thinking of stocks like Unity and I can't even think of them now, but Upstart and a few others, and some of the Bitcoin plays, Mara and Riot and Coin. They can be a lot of fun to trade, but this is not a good market for thinking that they're going to come back anytime real soon. So.
Well, and I just want to just say something very quickly, and then we can go on to the next segment here. But well, this is why Dr. Carr has a real advantage in the stock market, and because of that philosophy background and religious background, because you want to look at the markets, especially the way we invest. It's a lot more art than science, right? I was a bio major. I was science. There's a lot more black and white there, and if you keep it too black and white in trading and in investing, you can get tripped up when things just don't make sense. And you're seeing it with a lot of really smart people out there in Wall Street. They kept holding when the markets are going against them. They just kept holding to let their egos get the best of them, and sticking to their guns, even though the market was saying that they were clearly wrong. And so that's where I think that philosophy, understanding the trend and belief, right? Religion too, belief in the market and listen to the market. That's where that can really help you, because these markets will always turn before logic can, really make sense of it.
Well, and that kind of brings us to our next segment. So when we come back, we're going to talk a little bit about how you can kind of get those emotions out of the equation and really kind of look for those objective truths. Stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Peiris. He joins me every week from O'Neill Global Advisors. He's a portfolio manager over there. And of course, our special guest this week is Dr. Thomas Carr, a doctorate in philosophy and theology. And that might not seem congruent with your finance, big finance, analysis and everything like that, but there's a lot that can be brought to bear in the discussion with your investing philosophy, to use that term. And, Dr. Tom, I wanted to kind of just start with, one of my favorite allegories is the allegory of the cave by Plato, where, there's the folks that are in the cave and they're, looking at the shadows on the wall, and they kind of think that's reality. And, they're naming the shadows and everything like that. And it's not until one of the members gets outside of the cave and says, "Oh no, there's what we were looking at wasn't reality. There's an objective truth out there." And you fast forward a few hundred years, and you were just reminded of one of your favorites, St. Thomas Aquinas, in terms of that search for truth. So tell us a little bit about how you find your truth in the stock market, especially when, as we discussed in the first segment, you have these contradictory things coming at you, and you're just trying to find out, well, what is the truth here?
Yeah. Well, thank you. And that's a great intro. I love Plato, love that allegory. And I used to teach a course on the classical philosophy, which was my favorite all-time course. So I was just actually at a conference this last weekend, and it was on the writings of St. Thomas Aquinas. And I was reminded there at the conference through a bunch of papers that he has this very simple understanding of the truth. And I thought, in my market head, I've got kind of half a head that is devoted to philosophy, and the other half is devoted to the stock market.
Left brain versus right brain.
Every now and then they intersect.
Yeah.
And at the conference, I thought, the light kind of came on. So Thomas Aquinas defines truth as what happens when the image inside my head of the thing I'm thinking about matches the reality of the actual thing, the thing that I'm thinking about. So if there's an equation between what's inside my head and the reality outside my head, then I'm in the truth. I am the thoughts I'm having are true thoughts. Mm-hmm. Now, of course, Aquinas realizes that you're going to have a third part of that equation, because you need an objective viewpoint, that someone that can arbitrate between those 2 points of reality in my head and the reality outside my head. Because I don't know if the reality inside my head actually matches unless I have some third objective viewpoint that tells me so. And of course, for Aquinas, that's God or Scripture or the teachings of the church. And so I started to think, what is that third objective viewpoint, that God's eye view, as it were, in the market? Where does that come from? And if you throw out that question, I think, to professional money managers and traders and so on, you're going to get a whole bunch of different answers. There are folks that tune into CNBC listening to the talking heads, Jim Cramer and all the rest, and they're looking for that definitive objective view of the market. They're not going to find it there, of course. You can look at the Fed. The old adage, don't fight the Fed. Well, if the Fed is hiking rates, you should be out of the market. If the Fed is lowering rates, you should be in the market. Also not a very good way of going about your investing. In fact, the market, the Fed hiked rates the fastest and the shortest distance of time in history not too long ago, 2020 and 2022, 2023. And the market went up during that time. If you looked at the first hike to the last hike, it went up about 7 or 8%. It wasn't a straight line. It was up and down. But
right.
Back in 2016 to 2018, the Fed hiked a bunch of times as well. The market was up 20% during the same period. So no, it's not the Fed. It's not the VIX. It's not, which doesn't really work anymore anyway, because of these crazy expiration dates are all over the place now, like every day for the spider. So the VIX doesn't work. The leading indicators is no longer a good voice for recession. The inverted yield curve, no longer a good voice for recession. So what is that objective viewpoint? Well, the answer I find in the writings of William O'Neill. His objective viewpoint always was and always will be, for those who follow him, the price chart. The price chart is your objective viewpoint. So I can have a bullish bias toward the market. I can have a bearish bias toward the market. I can think the market's going to crash because of high credit card rates. I mean, they're really crazy. The credit card rates, not both in terms of interest and money owed and defaults, they're also all not looking very good. And I can look at that and think, okay, the market's about to fall. I look at the market. I look at the price chart of the market. It doesn't say anything about to fall. There's nothing in there that's telling me it's about to fall. And if you had just listened to the market and traded the market as it is presented to us on a day-to-day basis, you would be doing just fine, because the market's been very bullish since the October low and really bullish since the end of 2022. So, so that objective viewpoint in terms of the market is the price chart. That includes both price and volume. I think William O'Neill was right in including volume as an important key to understanding market trend and the likelihood that it's going to continue. And it's not an infallible predictor at all. And neither is price, for that matter, because a catalyst can come down the road, something unexpected out of the blue, and of course then everything is off the table. You've got to flex with that. But if you're just looking at the price chart, you look at QQQ, you look at SPY right now, and you're going to see bullish, bullish, bullish. And that's, as far as I'm concerned, that's the narrative going forward until otherwise known, until some other information comes out that the market will have to discount. The market, of course, I say this many times, is a future discounting mechanism. So it's always out there 2 to 3 months. It's already trading that first rate cut, which we'll probably get in May. A lot of folks still think we're going to get it in March, but I think more likely May. But we're there. That's where the market is. It's looking out there. It's looking past these earnings, which were pretty good, not horrible. They were pretty good all around, and looking out to the next quarter. So, if that's the case, then let's just listen to the market. Let the market tell us what it's doing. Yeah.
And a lot of times, I do feel like we refer to the market with almost omniscient qualities, right? It's, as you said, it's priced in, it's looking forward. But, I guess a lot of times there is that that pull to try and outguess the market, right? Well,
Sure.
the market is doing this right now, but if I can, if I can look out just a little bit further ahead than the market, then I can kind of see where it's going, in the future. So, is that kind of a fool's errand, or is there something to that? And look, I'm gonna call you out right now, just because you were kind of saying that. Well, based on how extended we are, are we looking to sector rotation to happen in the future? It's not happening now, but
Right.
You're trying to project a little bit to where we're going, right? Where the
and
puck's gonna be, instead of where the puck is.
And of course, all of us who are involved in the market on a day-to-day basis, we want to do that. It's our instinct to try to come up with a plan, a map. I always call it my daily map, right? This is what I think the market's going to do today. And to some extent, right, there are, of course, limits and parameters within which the economy and the market in specifically can operate. And so it always is going to run up against certain limits. However, the market is composed of human beings. Human beings who are making all kinds of decisions throughout the day, some of which are very, very important decisions. And their emotions are involved, their hope is involved, their fear, their greed are all involved. And so you're going to get a market overextensions, or how should we call them? They move too far too fast, and so they're bound to cool off for a little bit. Now, those are the kinds of things that we can make some decisions about. But as far as actually trading those, I don't like to do that too much. As I said, I'm not in small caps. I'm not in China. I'm not in energy right now. I'm in blue chip tech for the most part, and doing that through leveraged funds as well as individual names. And we'll talk about a few of those in the third segment here today. But yeah, it's you just have to take it day to day. I will say this: it is a fool's game, I think, to call a market top, because markets have this historic bullish bias, and the fear is a stronger emotion than greed. So the market does tend to get more overextended to the downside than to the upside. Markets like to climb a wall of worry, and there are always going to be bears out there, and there are always going to be folks who sell too soon, don't hang on to the winners, and so on. And that is just going to keep the ball rolling. It's not going to go up in a straight line, but it will go up. To the downside, however, because the downside is limited, right? It can only go to zero, and it can't go any further. That's one problem. And the other problem is that you've got a growing economy that every time it grows, there's a baseline that gets a little bit higher and a little bit higher. And so when markets start to roll over down to the downside, fear being a stronger emotion, you are going to get more obvious overextension to the downside. And there are some ways of plotting that out. So you can dig down into the market internals. You can start to look at things like bullish percents, NASDAQ summation index, put call ratios. These are the kinds of things that will highlight excessive fear. And there are moments. They don't happen very often. We had one in October. We had one in 2022. There are moments when you got to back up the truck. You got to put a second mortgage on the house, and sell the car and put all that money into the market, because it's a very good buying moment, and they don't come around very often. But doing that for the top, as we saw with the professional money managers, right? They got out too early way back then. They're probably getting out too early now. It's a much, much more difficult process to call a market top.
So, Dr. Carr, so you just came back from the 3-day conference in religion, and you've obviously been studying religion for a long time. Are there a number of lessons there that have translated over to the stock market, and especially with kind of these extreme markets where fear takes the best of everyone, right? And human nature takes over, and psychology. Has that helped translate and maybe made it easier for you versus a number of others who are getting into the market?
Well, yes, it has. Actually, my doctoral dissertation was on the theory of interpretation.
Mm-hmm.
And I should say theories, because there are competing theories out there. And I was working in one particular field. And this comes into play into the area of religion, because scholars are interpreting ancient texts, right, written thousands of years ago, hundreds of years ago. And how do we understand that in the light of the current context? So that the discipline of interpretation involves the bracketing off of your prejudices or biases or your prejudgments toward what it is that you're interpreting. I think that's a perfect way of approaching the market. We come to the market, of course, with the desire to make money. I mean, that's kind of the given. That's sort of the intuitive form of stock trading. But we also need to understand that if I think the market is going to do A and it ends up doing B, I'm going to be in a lot of trouble. So I need to come to the market and not think either A or B, and allow the market itself to say what it's doing. Let the market tell me what it's doing. And of course, there are ways of measuring that objectively, right? You can measure the relative strength. You can measure a comparative, as we saw before with the sector indexes, and you can see what's hot and what's not. So the market will reveal its hand, so to speak, and tell us what it is. And we don't necessarily have to interpret it. We simply have to receive it and then respond. Our response, of course, is the key thing. So how do you respond to a bull market? How do you respond to a bear market? How do you respond to a long-term bull market that's maybe long in the tooth? What do you do in a market pullback that goes back down to an area of support? And there are all sorts of different ways of approaching the market, trading the market, benefiting the best from those scenarios. But again, the market has to tell us those things. We don't come to the market and say, I'm going to put on a bunch of inverse hedge funds right now, inverse exchange traded funds, because I know the market 2 weeks from now is going to be lower. Well, I don't know that. I might think it might do that, but there's no guarantee. So we just, we get in there day to day. And the one difficulty when the market's in a tight trading range, which the S&P has been in, is starting to break out. The NASDAQ is still kind of in about a 2-week base or so. The small caps are definitely in a very tight trading range and not really going anywhere. The difficulty in that time frame is that in that kind of market is that you're going to get frustrated day to day. You're going to get long on a day that looks great, and you're going to get at the top of the range, and then the next day it's down at the bottom of the range, and it just, So one of the things we do in response to that, and we love trading ranges actually, is we do a lot of put premium selling.
Yep.
We sell puts.
Mm-hmm.
And then, if you get put into shares, you've got your favorite stock at a discount, which I love. I love to buy at a discount. And if you're put shares, then you turn around and you sell calls, right? You just do this wheel play over and over. So we've been doing that a fair bit. We do that with Apple, with Google, and a few others.
Mm-hmm. Well, that seems like a good place to kind of wrap up here. And I just wanted to also point out, kind of to Arusha's original question on that kind of use of religion. I think some people might be interested in one of your initial appearances. It's called Faith and Trends, and that's something that people can find when you're on the podcast. Talking about how you kind of came to your investing career through theology and philosophy. So definitely worth watching that. That can be found on YouTube or, of course, on investors.com. It's titled Faith and Trends with Dr. Thomas Carr. So when we come back, we're going to take a look at one of the screens that Dr. Carr uses quite a bit, and some of the stocks that are coming up on his radar right now. Stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Paris. He's a portfolio manager over at O'Neill Global Advisors, and he joins me every week. And also, we have as our special guest coming back to the show, Dr. Thomas Carr, also known as Dr. Stoxx, the founder of drstoxxtrading.com, and also the CEO and founder of Befriend the Trend LLC. So let's get into some stocks. So first of all, let's start with one of your favorite screens in terms of how you find stocks. And again, in your search for truth, let's say.
Okay. Well, yeah, just remind our audience that what we're doing here is we're using tried and true tools to find the leaders of the market. I learned this from William O'Neill, reading his book and hearing his webinars and so on. And, he used to give a Sunday webinar. Some of you probably attended these, and he would go over the market, the general market. He would talk about politics for about half an hour, and then he would get into the stock charts, and everyone would get so excited on Sunday night for the charts that he was talking about. They would rush out Monday morning and buy the stocks. And that's kind of what we do now with MarketSmith. MarketSmith is the William O'Neill consolidated. So I assume now you can see MarketSmith on your end.
Yeah. Mm-hmm.
Okay. So I'm going to open up the editor of what I call my A-list scan,
Mm-hmm.
and give you a kind of peek under the hood, as it were, of what is involved in this scan. Now, MarketSmith comes with a variety of pre-built scans, canned scans, and you can use those to find some great leading stocks. I tweak most of those a bit, and then I also use the proprietary MarketSmith metrics for fundamentals and technicals, because I think they're so good, and they really, this is like it's like a scanning tool on steroids. It really is very, very robust. So I start off with the EPS rating, which is a measurement of both EPS growth and accelerating growth over time. I want to give it at least an 85 ranking to that. So 85% of the stocks trading out there are worse off than the ones that are going to come through this filter. And then the relative strength rating is at 85 as well. So we want to make sure that we're getting stocks that are actually in an uptrend, or have been in an uptrend, or starting to trend higher. An SMR rating of A, and to me, this is one of the keys to my A-list scanning tool. And SMR stands for sales growth, margins, and return on equity. And you put those three things together, and you get two very important pieces of a company. You get their pricing power, because their sales are good and their margins are very good and growing. And you also get very good management. So if you have a high return on equity, 25% or more per year, that means the management knows what to do with the company. They're very efficient, they're making good returns, and so on. So SMR is what Warren Buffett talks about as a moat around the company. If you got an SMR of A, you've got a good moat. I want a accumulation distribution rating of an A or B, which means more shares are being accumulated than being distributed. The individual group that this stock is in has to be at a strong relative strength. So we're going to leave that at A. That's the best. Means every stock in that group, whether it's semiconductors or cybersecurity, or industrials, is also very strong in terms of its relative strength. A comp rating of 90, minimum of 90. I want a pretty liquid stock, so 500,000 shares average being traded per day. That's my minimum. A current price of $15 per share. We don't want to trade penny stocks. We don't want to trade stocks that are way down below $15 a share. And in fact, most of the stocks we trade are in the triple digits. An EPS estimated current year of at least 1%, which is to say that this year over last year, the company has raised its forward estimates for the current year of at least 1%, which is just basically a way of saying the company is more hopeful for next year, or for this year, than they were for last year. And then we do the same thing for next year's earnings. So the company is more hopeful for next year than it is for the current year. If you get those two together, you've got a really good growing company. Len Zacks, who's the founder of Zacks Investment Research, he did his MIT PhD on this particular fundamental metric, and he learned that this was the only fundamental metric that had a consistent positive correlation to forward price movement. So you got those two together, you've got, you've already kind of ruled out stocks that are not going to be doing as well over the next quarter. And lastly, a timeliness rating. So this is your technical strength, setting up inside of a base or a pattern of some kind, a bullish pattern, a continuation pattern, maybe a new breakout. And that all comes under the timeliness rating, and that's an A.
Yeah.
And you click on that, you get 29 stocks that flow through all those filters, which is a good, healthy set to choose from.
And I just want to point out that
Yeah.
the starting point was 10,114, names from the database. The EPS, that knocks it down to under 1,000. So you get rid of 9,000,
Right.
straight off, and then you knock another 6 or 100 or so with the RS rating, and then it's just kind of fine tuning from there until you get down to your 29. So again, no one wants to go through 10,000 stocks, but 29, I can have
29 is manageable. That's right. Yeah. And we can even go a little bit further. If you go over here to the far right, you'll see a column called comp rating. We just click on that, and it will rank all the stocks, those 29 stocks, based on comp from best to not so good. Of course, 90 is our minimum, so they're all pretty good. Mm-hmm. That brings up 3 at the top here, at least a couple at the top. There's Annette, which is a
networks, right?
Yeah, mm-hmm. Yeah. They do the hardware for computer networking. Great. I mean, the fundamentals are just off the charts. You've got 2 little green triangles here. I always call those the green eye candy. It means that the estimates are going up. You can see how much they're going up: 43% this year, 11% next year, and relative strength is good, 96. I also like about this chart, you have the 3 primary moving averages. And here we're talking now about looking at the price chart and letting it tell us what it is. It's telling us it is very bullish because we have the 20 period moving average above the 50. We have the 50 above the 200, and they're all rising. You can't get any more bullish than that. So you've got 3 stacked SMAs, and they're all in the right position, and they're all in an uptrend.
Yeah.
Now, do you buy this like tomorrow morning? Well, you could, because it's actually a little bit below the 52-week highs. It's pulled back over the last couple of days, just a bit, just a smidge down to the 20-period moving average. A better entry would be something that would be more of a multi-week, 2 to 3 week pullback, something like here, nice soft little landing pullback into the rising 20-period moving average, about 3 or 4 days in a row of just holding steady there. And then you buy the big breakout bar. You also want to look down here at volume, and you're going to see a lot more blues than reds and a lot taller blues than reds. And that's, of course, exactly what we want to see. That's the beauty of that accumulation distribution rating. It weeds out those that have a pretty negative or bearish volume balance. So if you look at this, and we're talking about that objective viewpoint, the reality inside my head is that this is a bullish chart. The chart itself is telling me that it's a bullish chart, and the third objective principle is the chart itself, which seems to be quite bullish. So we've got everything.
Well, I guess the question though is, and maybe you could go to the weekly chart for this. You look at this, and our big question is, are things extended? This, as you mentioned, it's at 52-week highs, down 3.6% from its 52-week high, and you can see that in the upper right hand corner. The up down volume ratio, that's 1.7, but this has been running, and it's it's getting extended. So to your point, this came off 3.6%. Is that enough? You were kind of mentioning that move that was to the 20 period, which was maybe a little bit of a better entry. But how do you kind of act on something? Oh, also I should mention that we're seeing that this has earnings due in 5 days. Right. So that's another factor.
I always counsel folks, don't hold over earnings unless it's a long-term investment. That's fine. We have positions in stocks that we've held for several years, and of course you hold those over earnings. But if it's a trade, no. Now, trading it, buying it into earnings and selling the day of prior to the earnings that evening, perfectly reasonable thing to do, because stocks often, when there's a lot of anticipation in a very strong company like this, and you can go back over the last 2 quarters where they really blew it out of the park, right? Really got running high after earnings. Of course, they sold off into earnings. So it's one of those things, you try to find the pattern and you're sooner or later going to find some evidence that runs against it. But no, there's not a lot out there in the market that is at a support level after pullback.
Yeah.
Right.
So Dr.
Not even the leaders anyway.
So Dr. Stock, maybe let's just go through one more on this list, and we'll just go to the second one right here, right? The CrowdStrike, and we can walk through this. And you're right. Yeah. Now this is where I think all of us might have, or a number of us might have, a difference in opinion in philosophy here, right? Where if you're a shorter term trader, if you have a shorter time frame, even emerging out of this small little 2-week trading range, that might be an entry for some. But for others who might be following kind of the more traditional O'Neill methodology, they may say, you know what, it's extended, we got to let it pull back, or maybe you add to the 21-day. But how do you see this stock, and what do you like about it?
Well, for one, it's in a great sector, and the sector has been shifting out and sifting out, I should say, some of the weaker members. Fortinet, I think most of these guys are rising. Most of these cybersecurity plays are rising on Fortinet, which came out last night. It was beaten down horribly in the last couple of quarters and came out with a wonderful report last night and was way up. Now, it did come almost back all the way down to the entrance, the previous close by the time it closed trading today, but it really shot higher and it put a big spur underneath. The 2 biggies in that group are CrowdStrike and PANW. I can't think of the
Palo Alto.
Palo Alto. Yeah. So this actually is a classic William O'Neill base breakout, right? It's a tight base, about 2.5 weeks. I mean, if you go back a little bit further, you can kind of say the base was forming back here, so about 3 or 4 weeks. Now, this is a short-term trade, so you're going to look for about a 4 or 5 day move. And when you get that first red bar, you're out. Or you trail up a stop. It's even better. Trail up a stop under the lows of the previous day and let the market take you out of the trade. So we're just looking at short-term trades here, but you want to make sure that you're doing that kind of thing in leaders like this. It was very, very bullish. I mean, look at the volume balance down there. It's very, very healthy. The SMAs are exactly where you'd want them. Yes, a better entry would be right here, about 238 on that pullback into the rising SMA, or even back here, 170, pull back into the rising SMA near the 50. But we're not there. We're up here. We have to trade what the market gives us. And we've got a 3-week tight base with a breakout today on very good volume. So that should see some follow through. And there's nothing in the market, as far as I'm seeing, that is going to tell us that we're at the top here. So as long as the market continues to not go down, it doesn't have to go up, but as long as it doesn't go down, then a trade like this would be pretty good.
Yeah. And I should disclose that I do have a position in this myself. I think my average cost is around 165, between 165 and 170. So I've got a lot of cushion on this one, and I've just been, letting it ride. I was actually adding a little tiny bit as it crossed 300 here. But could you go to the weekly chart? Because again, one of the issues here, as with a lot of stocks, you look at the weekly chart and it's just, it's had this, phenomenal move, kind of cleared the old highs of 2021 with ease, kind of, paused there for a little bit, and then, really kind of, plowed through. As you mentioned, the base, this most recent base is 2 weeks, which, normally Bill was looking for bases at least 5 weeks for the flat base and, longer for the cup with handle. So not a base in terms of that position trade, but as you mentioned, you're kind of looking for, short-term trades, things that have paused a little bit for maybe just a small gain going forward, right?
Right. You either get a small pause down to, you can drill down to the hourly chart and you're going to see a line of support. You buy some shares down there and then buy a few more as it breaks out of the top end of the range. That's one way to trade something like this. But all of this has got to be very short term. We're just not in the kind of market that is a back up the truck kind of thing. Now, personally, for me, what I would be doing with something like CrowdStrike is selling puts. Sell the 300 puts and hang on to those for a week. And, you're going to be pulling in, I don't know, $200 or $300 per put, as long as it doesn't cross back down below 300. And if it does, then you're into the shares at a discount. But for short-term swing trade, if you want to buy the shares, it's maybe a little late today to get in, but it was certainly a good day to get in today early on. And then you trail up your stop underneath the pivot lows of each new bar.
Yeah. And as a reminder, when you're, selling puts, or selling calls, if you're doing that, naked, make sure that you've got kind of the cash, available,
exactly.
and that it makes sense for you, right?
Right.
Because in this case, it's a $300 stock. Do you want to have, 100 shares of it? That's a contract. So, you do the math, and that's a $30,000 position. So make sure that's something that you're
absolutely. No, I agree. And you have to have a large account to do that. And your broker won't even let you get into the position if you don't.
That's true.
Yeah, right. Exactly. So, well, hey, Dr. Thomas Carr, always a pleasure having you on. Thank you again for, the little philosophy and theology lessons. Good to have the professor in for those discussions, and we'll see you next time. Really appreciate it. And I also want to just mention that for those that want to kind of get more information, maybe following you on Twitter would be a good idea. That's at Dr. Stoxx, STOXX. For the Twitter, or I should say X, formerly known as Twitter. So thanks again for being on.
Thank you, Justin. Thank you, Rusha. I appreciate it.
Okay. That's going to wrap it up for us this week. Please join us next week. It's going to be a little wee time on Valentine's Day. So Arusha and I are going to spend that together. So we'll see what we can find, and if the stock market is still something we love, or if we're going to break up right before Valentine's Day, so we don't have to get it a gift. So thanks a lot for watching. We'll see you next time.